Hi, I'm Emily Young, Executive Director of the Nonprofit Institute at the University of San Diego. I'm very pleased to present Anna Diaz, who is a principal at Dowling and Yahnke Wealth Advisors, and she's also an advisory board member to the Nonprofit Institute. Anna's going to talk to us today about charitable giving in 2021 and ways nonprofits and donors can maximize opportunities for giving. Take it away, Anna.
All right. So what we're going to try to do in 9 minutes is cover charitable giving strategies, and it's going to be charitable giving 101 and try to be as efficient but helpful as possible. So why are we discussing charitable giving techniques? As we all have conversations with individuals in the community, as board members, as leaders, as community members, it's important for us to be conversant on these charitable giving techniques. We are also entering, as we're all aware, we're kind of giving season. Starting now to the end of the year is when many individuals contemplate their giving. So we want to be able to talk through this. And we also want to know, as we as individuals, as I contemplate how I want to support great organizations like the Nonprofit Institute or the others that I care about, how I might choose to fund that giving. So let's now talk about a couple of these strategies. So the first, let's talk about cash giving. So cash giving has always been a great way to fund some of your charitable organizations, but the CARES Act, which was passed last year, as we all know, to support the pandemic, there was a very special provision around cash. And there are two things to think about here. One, is there now a $300 above the line deduction? What does that mean? Is that typically when someone is giving charitably and to get the deduction for it, you had to itemize, and that's something that's on your tax return. But now if you give $300 or less, you automatically get dollar for dollar deduction. You do not have to itemize. Why is that important? A lot of nonprofit organizations depend upon these smaller givers. And when you add up a lot of these smaller givers, they really add up to meaningful dollars. So one, that's good to know. The second is that as we do give cash more than $300, we now have the limitation been increased to 100% of adjusted gross income. What does that mean? Well, before, if you were giving cash prior to the CARES Act, you were limited to 60% of your adjusted gross income, which is a figure that shows up on your tax return, on an individual's tax return. Now we have now up to 100%. And again, before it was 60. So when we think about our giving and as individuals contemplate this, it's good to contemplate what is your taxable income relative to charitable giving level. Depending upon that relationship, this could be a very unique opportunity to give. Okay, now let's talk about giving appreciated securities. And appreciated securities are essentially investments that have grown in value. They've appreciated in value. And when we think about giving appreciated securities, it's kind of a quadruple benefit. I'm going to walk you through why it is. One is that let's just say I bought $10,000 worth of Amazon stock. And I bought it 2 years ago and it's now worth $20,000. I'm really quite happy. It's doubled in value. Now, as I've had that $20,000, I might choose to say, I'm going to give that $20,000 in Amazon stock to the Nonprofit Institute. So what do I get? Number one, I get a deduction for the $20,000 worth of fair market value of that stock to the Nonprofit Institute. The second is that I avoid paying that capital gains tax. So let's think of it the other way. Let's say instead of giving them the Amazon stock, I said, I'm going to sell that Amazon stock of $20,000 today, but I'd owe gains tax on the difference on that $10,000. But instead, by having given it to the Nonprofit Institute, I'm forever removed from having to pay that tax. They can sell it easily and have no tax consequences. So it's a double benefit there. Now let's talk about the third benefit. Rebalancing the portfolio. So I'm in the money management space. And so what that means is when you're managing portfolio assets, the goal is to be diversified and watch any concentrations you might have. Some of these stocks have done very, very well. And so the intent, if you're disciplined, is to reduce some of them over time. Well, if you try to reduce that, again, you're paying tax. So by having given, again, that Amazon stock to the Nonprofit Institute or an organization I care about, I've naturally done some of that rebalancing I would have probably done anyway. And the fourth benefit, it's supporting the great organizations that we care about. Okay, let's talk about donor advised funds and bunching. So here's another idea. So there are right now in this particular tax year, a lot of individuals, and I'm seeing this very common, very large tax year. And that's a function of people selling things. They're selling investments, they're selling businesses, they're selling real estate, and that's creating high taxable income years. So individuals are in that scenario are then thinking, well, what can I do to mitigate that tax? These concepts can be helpful. And so what does this look like? let's say I have an individual who's been giving at the $10,000 level to the nonprofit institute for 5 years, or plans to do another 5 years. So that means over the next 5 years, they're planning to give $50,000. That's wonderful. But they're recognizing this particular year, they have a big tax year. So instead they might say, well, I'm already intending to give $50,000 to the nonprofit institute. I might choose instead to give $50,000 today, this tax year, to maximize the tax benefit into a donor advised fund. They get the charitable deduction for the $50,000 this year, which is very advantageous. And then once it's in the donor advised fund, they can parse out how they want those funds to be given to their favorite organization. Maybe they accelerate it, maybe they give it on their original plan, but it's a great way to combine both intended giving with the opportunity of current tax rates and current tax environment. Now let's talk about qualified charitable distributions, or QCDs. And these are a great technique applicable for a very specific population. That population are individuals who are over 70 and a half years old, who have retirement accounts, and they don't think they're going to need the full amounts from those IRAs. What the IRS has given us is the ability for those individuals to take up to $100,000 out of their IRAs and give it directly to a qualified charitable organization of their choice. And that is extremely helpful. And why that is because starting at 72, those individuals are forced to take out money of those IRAs, whether they like it or not. And there are many scenarios where people aren't spending all that money. So they're saying, gosh, I'm getting this money back. I'm getting taxed at the highest rates for getting it because you're now getting taxed on it. And then also on the side over here, they're supporting great organizations like the Nonprofit Institute. So instead of separating those points, we combine them and we say, okay, well, if I don't need that full amount of my required minimum distribution, I might choose to give a portion of that to the Nonprofit Institute. And that's a fantastic way to satisfy the required minimum distribution and not have to pay tax on that income. One of the most powerful techniques to think about for that particular demographic. The last thing we're going to talk about is giving within your estate plan. And this is a very simplified form, but ways to think about it. So when we're thinking about supporting our favorite organizations in our estate plans, that means we're thinking about how these organizations can be supported after life, after my passing. And there are two general types of assets, two ways to think about this. There's your retirement plan assets, and those are IRAs, just like we talked about, 401ks, those types of assets. And then there are non-retirement assets, such as life insurance, real estate investments, financial assets. All of those would be kind of non-retirement assets. There are many life insurance policies that people find where they've paid up and they realize I may not need the death benefit of life insurance. You can name your favorite charitable organization as a beneficiary on that policy. So now let's think about, why would someone contemplate naming a charitable organization in this way? So there are many charitable families and individuals who say, I love supporting the Nonprofit Institute and other organizations. Would I love to do more? Yes. Do I feel comfortable? Because I have to make sure I can take care of the needs that me and my family have. Sometimes that can be hard. So by naming that organization in your estate plan, that's ensuring that you have the ability to have your wealth support you during your lifetime, but there is a really powerful impact on those organizations you care about as you pass. In addition, this can reduce estate taxes, possibly. So right now there was actually a bill proposed this week, which would decrease the estate tax exemption, which means that there will be more estates subject to estate tax. And that estate tax is 45%. So many individuals are saying, gosh, if more of my wealth is going to be taxed when I pass, if you choose to give part of that to your favorite charitable organization, you could heavily reduce your estate taxes or possibly eliminate estate taxes. So how do you do this? What you do is, if you have a retirement account, so an IRA, a 401k, you name them as a designated beneficiary. It's a document that you signed when you opened the account, if you have, if you had one, but you can always update it any time, and you can name the charitable organization. You could name a dollar amount, you could name a percentage, you could name a full amount. And then the other way is for those non-retirement assets, you name the charitable organization in your will or your trust. And please consult your estate planning attorneys, your legal advisors, or financial advisors, or your tax advisors to perfect all of this. But it is a way that you could also name your charitable organization. And just like the IRAs, you could name amounts, you could give percentages, you could give specific assets. All of that is possible with what you're searching for. So I hope I covered some helpful information as quickly as I could in 9 minutes.
Thank you so much, Anna. And does anybody have any questions for Anna in the last couple minutes that we have together today?
I'd like to know whether the Roth IRAs are covered by your last slide.
Roth IRAs, you cannot do a QCD out of a Roth.
Okay.
Yes, yes. No, and that's a good question, because the benefit of the QCD is to not have to pay the income tax that otherwise would have been paid, which IRAs are subject to, but Roth IRAs are not. They are permanently tax-free capital. So any dollars you take out, you're not paying tax on. So it's frankly one of the better assets you'd want to leave towards maybe non-charitable beneficiaries, honestly.
Okay. Thank you.
Well, thank you so much, Anna. We really appreciate your giving us your time and your expertise today. And this session has been recorded. And just so you know, this is a teaser as well for an upcoming webinar about which you'll receive news sometime today in your email. Anna and John Kramer will be joining forces in October, on October 12th, to provide a longer presentation about why this year is an especially good year to give and what nonprofits and donors alike should know. So thanks again for your time today, and we look forward to seeing you all soon. Take good care.